Good morning, good afternoon, good evening, wherever you are in the world. I'm Nicolas Véron. It's my pleasure to introduce this new session of the Financial Statement series at the Peterson Institute. And once again, we're talking about the Basel standards of the Basel Committee on Banking Supervision. Some of you may think I'm becoming a bit too obsessed with Basel. It's the fourth session in a year that we're doing Basel worship. But Basel is important, and we are taking a slightly different angle this time because we will be talking about assessment processes, about compliance. But most importantly, we're having two extraordinarily experienced speakers today, not to say that the previous speakers weren't, but here I hesitate to call them living monuments. I'm not sure that's appropriate, but certainly two fantastic not only witnesses, but also past and present players in that prudential space. They don't need introduction. I will still introduce them. Stefan Ingves studied in the US and at the Stockholm School of Economics. He got his PhD there in 1984. He worked in the private sector at Handelsbanken, at the SOFE Options Exchange. In 1988, he joined the Ministry of Finance of Sweden and became the Director General of the Bank Support Agencies. That was the time of the Swedish financial crisis. The early 90s. We may come back to that experience. In the late 90s, from 95 to 98, he was deputy governor of the Swedish Central Bank, the Riksbank, then joined the International Monetary Fund as director of the Monetary and Financial Affairs Department from 1999 to 2005. And as he will probably remind us, this was also very germane to our topic today because of the parallels between the Basel assessment process and the financial services assessment program of the IMF, the FSAP for the connoisseurs. In 2006 and all the way to N22, Stefan was the governor of the Riksbank. And in that capacity, of course, he covered the whole span of the great financial crisis, but also from 2011 to 2019 was the chairman of the Basel Committee on Banking Supervision. Since then, he has been affiliated with the Swedish House of Finance, which is an institute of the Stockholm School of Economics, but also the chair of the Toronto Center, which is not a very public organization, but is very important in the supervisory space as an institute that does training for supervisors all around the world. Stefan has authored many publications. I will only mention the Nordic banking crisis from an international perspective, which he authored back in 2002, and many other books and other contributions. Patrick Honohan Patrick Honohan is matching the record held until now by Anna Gelpern of the most frequent speaker in this series. So that's the third time Patrick is at Financial Statements, and thank you very much for that, Patrick. He studied at University College Dublin. He had an early stint at the International Monetary Fund, and he was at the London School of Economics, where he got his PhD from in 1978. He then worked at the Central Bank of Ireland in the government as economic advisor to the Irish Prime Minister, or TSEC, if I pronounce it correctly, which I probably don't, in the mid-1980s. He then worked for first stint at the World Bank, then at the Economic and Social Research Institute in Dublin for most of the 1990s, and then again in 98 at the World Bank, where he stayed until 2007, when he joined Trinity College Dublin as a professor. Of course, he was governor of the Central Bank of Ireland from September 2009, the date is important, to 2015. So he covered also the peak of the Irish banking crisis, and especially the cleanup phase of the mess in the Irish banking crisis. So very parallel experience from that perspective to that of Stefan in Sweden, but in a different context. And after leaving the Central Bank of Ireland, he is an honorary professor at Trinity College, but most importantly, of course, from 2016, he has been a colleague and a senior fellow at the Peterson Institute for International Economics. I should mention among Patrick's many publications, The Central Bank as Crisis Manager, which is a book that was published in October and will be actually featured in a forthcoming event at Peterson on December 11. But for now, we're focusing on the Basel Committee. And with that, over to you, Stefan.
Thank you, and thank you for that very nice introduction, and most welcome all of those of you who are watching. I'm going to start talking, showing some slides. Let's see. Let's hope that I can get this done in an orderly way. So the topic of today is the Basel Committee's assessments. The Basel Committee for Bank Supervision has been around for by now almost 50 years, but has not really been deeply involved in doing assessments for that long. And I'm going to give you a kind of a background story where these assessments came from and how these things evolved over time. So it's my own story. It starts in the 1980s and in the early 1990s. And what happened then in my country, Sweden, was that we had general macroeconomic imbalances. We had a fiscal crisis, a serious fiscal crisis. We had a currency crisis, a serious currency crisis. And we had a systemic banking crisis, which was a major thing because the last time a bank went bankrupt before that, I think, was 1905 or something like that. So we were not really used to having these bad things happening. So that's part of my background, and this, of course, has affected my thinking when it comes to what the Basel Committee has done and what many others have done as well. Financial crises, they have significant long-run costs. These graphs come from the BIS when I was chairman of the Basel Committee, and this is truly what I would call eyeball econometrics. One line there in the middle, it shows when the financial crisis started, what happened to GDP per capita in the US, Japan, UK, Korea, Mexico, and Sweden. And you can look at a number of other countries and you will find similar results. And essentially the conclusion is that if you run into a financial crisis, that will affect the economy, and it will affect the economy for a long time. It's a high cost to society as a whole, and it's almost impossible to later, so to speak, claw back what you have lost. And this is an important and good mental starting point when people start arguing back and forth about rules and regulations, and many tend to forget this. So why then? Why is it that this really mattered? Well, first of all, when I was deputy governor at the Riksbank, we asked ourselves, why is it that it makes sense to produce a financial stability report? And that's what you see here on the right-hand side. First of all, maybe it helps when it comes to making sure that bad things never happen again. That has proven to be wrong because bad things have happened since as well. It's, as I said, a huge cost to society as a whole. It's absolutely grueling work, and Patrick probably can talk to that as well, to deal with the financial crisis and dig yourself out of the hole that you ended up in. So to do some kind of an ex ante warning system would be a good thing, hence a financial stability report. And financial stability matters, but at the same time, let me stress that this was not high on the agenda back then. And no one actually asked us to do this at the central bank, so we just did it on our own. Now, fast forward, I ended up working for the IMF, and back in 1999, we started a pilot program to do what came to be called financial sector assessments. And those financial sector assessments, they are essentially de facto financial stability reports, and partly actually based on what I did and others did at the Riksbank in the late 1990s. This program has been highly successful in the sense that it has become part of the regular work of the IMF and the World Bank, and all major financial centers in the world find themselves in a position where the IMF, World Bank show up, let's say once every 4 or 5 years, and take a close look at what's going on in the financial sector. That's an element of the background work when it comes to the financial sector assessments. What really matters is what I call background preconditions. And that really has something to do with standard setting. And these standards are called ROSCs in IMF parlance, Review of Standards and Codes. There's a whole bunch of them. An early one was the Central Bank Code on Transparency, managed by the IMF. There is another one on accounting by IASB, the International Accounting Standards Board. Then on banking, there was the Basel Core Principles for Supervision done by the Basel Committee, but surprise, surprise, done actually the assessments were executed by the IMF, not by the committee itself. We have payment systems and market infrastructure done by the Committee on Payment and Market Infrastructure. We have securities done by OSCO. We have insurance done by the International Association of Insurance Supervisors. We have money laundering standards and so on and so forth. And what that actually means is that today, and starting about 25 years ago, a system evolved slowly over time, making it possible to assess what various jurisdictions in different corners of the world were doing or actually not doing when it comes to being in compliance with these standards. And those standards actually tell you something about to what extent you have your house in order or not so when it comes to what you are expected to have in place in terms of supervision and your domestic governance structures. Now, fast forward to the work of the Basel Committee, the Regulatory Consistency Assessment Program. Again, no one asked for it. And the problem with the Basel Committee when I was chairman during those years was that no one really knew the degree of compliance back then with Basel III, II, and eventually parts of Basel III. And that meant that the time was ripe to actually try to assess to what extent you were in compliance with what had been agreed at the Basel table or not. And at the same time, given that the IMF, World Bank work, and other types of assessment had by then been going on for about 10 years, more transparency in one form or the other was actually accepted. And that meant that no one really objected. And the assessment technology was readily available, and it had been tried by then with success many, many times by others. And I also think that despite the fact that no one really talked about it back then when these things were decided, if the Basel Committee did not do it, somebody else would do it. And in that sense, there was also an element of turf in this, but it really, really made sense, at least from my perspective, to have the Basel Committee doing this type of work. And that gave birth to the Regulatory Assessment Program, the Regulatory Consistency Assessment Program. And here on the right-hand side, you can see the first page of something called the Handbook for Jurisdictional Assessments. And it's about a 50-page document describing how you would go about doing these types of assessments when you go to a certain jurisdiction. So, and then over time, the RCAP process has also evolved, and we have 4 things that are important. The first one is obvious, which is jurisdictional assessments. You send a team of assessors to a country/jurisdiction, and they check to what extent you have done what you have promised to do, and to what extent you are doing it in such a way that you are in compliance with what was agreed at the Basel Committee table. And then from time to time, given that Basel III is a complex set of rules, you do follow-up assessments, because from time to time people do what they've been told to do, and then they are happy to have somebody come and take a look and verify that they have actually done it in such a way that they were expected to do. And in addition to this, when you do many assessments, it puts you in a position where you can produce monitoring dashboards so that you can kind of in a convenient way summarize what has been going on in this field over the years. And those monitoring dashboards have become actually quite important when it comes to summarizing where countries are vis-a-vis what has been agreed. At the same time, I would say that both compliance and the communication that goes with it is much more important today than, let's say, 20 years ago or 30 years ago, when that wasn't all that high on the agenda. because in this day and age, with much more publicly available information than in the past, you are, if you sign up to being a member of the Basel Committee, kind of expected to be able to explain to others what you are doing or not doing. And this is a summary table. I'm not going to go through this at all. It's just an example of showing to you what these things can look like. This is a summary of the Regulatory Consistency Assessment Program, the BCBS RCAP, using the short form. And you can see there within the red where it says Basel III standards adoption. And then you can, when you have filled this matrix, you can see exactly where countries are, to what extent they have completed the various bits and pieces or not completed them. And green is fine. Yellow is somebody saying we're going to do it or we are on our way to doing it. And red basically says that we haven't done it. And then, of course, there is a myriad of available information behind the scenes, so to speak, when you go to the different country reports. But in my view, no one asked for this. It has evolved over time. People seem to be happy with it. But at the same time, it's quite a challenge when you go to countries when you have to tell them that they are not in compliance, when they would like to say that they are in compliance, but not quite, when they have some homework to do. Thank you.
Thank you so much. Patrick.
Thank you. Yes, well, I like to look back a little bit further than Stefan has. And if you think about it, this is a growing business, this international peer review of financial sector policy. It's a growing business. And it's one that has had, I think, mixed success. These particular reviews we're talking about here, the jurisdictional reviews, RCAP, Regulatory Consistency Assessment Process of the Basel framework, are just one component. Stefan said that, to be set alongside the reviews of the international regulatory bodies' standards and codes, typically carried out as part of the IMF World Bank EFSAP program. And also there's an increasing number of nationally mandated external reviews of central banks that are being conducted these days, an entirely different framework, sort of bilateral. Now, if you think about it, such assessments date back a long time to the interwar period, say 100 years ago. You had money doctors. Famous one was Edwin Kemmer, American academic, and he went all over Latin America, Philippines, all sorts of places, guiding the creation of new central banks in countries in the American sphere of influence. And there were other money doctors. There were British money doctors. There were French money doctors. There were Japanese money doctors. Kemmer is most famous. The question I want to ask is, cui bono, in whose interests are these assessments carried out? And I think there are different goals. And I think that the purpose of these jurisdictional assessments of the Basel framework that we're talking about today, I think the purpose is a bit different from those of from that of other reviews. You see, one interpretation is that the money doctor provides a service to the host country, helping that country to establish strong and effective institutions, underpinning stable, efficient, competitive financial sector. And I think that was certainly the goal of the Basel core principles that Stefan referred to. That was Basel core principles for effective banking supervision. That was the first of the modern standards and codes, and it was promulgated in 1997. But it was focused really on emerging markets and developing countries. It was really designed. It was written by the Basel Committee more or less as a sort of annex. They made the agreement on capital, but they said, maybe we've learned a lot about bank supervision. Maybe we could tell emerging markets about this. And that was where that was coming from. And it was really helping those countries, not really centered on protecting global financial stability, spillovers and that, because that issue had been, as they saw it, resolved at the level of the 12 member countries, dozen or so member countries at that stage of the Basel Committee. But the Basel Committee's capital accords, and now the Basel framework, which is bigger than that, it only started with a dozen advanced economies. But it's often thought of especially since the global financial crisis, as being precisely designed to protect against spillovers and more generally to protect global financial stability. But I think the Basel framework can also be seen in a rather different light. And indeed, this is acknowledged completely if you look at the text of the Basel Committee. But it provides a level, competitive playing field for the major international banks headquartered in different countries, so that prudential regulations in one country are not so slack as to allow a competitive advantage to home firms when their competitors are being constrained by their national prudential regulations. And that's where the Basel Accord came from originally in 1998. It's a sort of compromised prudential design. I mean, you can do prudential supervision regulations. They can be done in lots of different ways, but this was a compromise, not allowing people to exploit gaps in one country, another country, which could have undermined the whole thing, but also, above all, undermined the international competitiveness of the big banks in some countries. So now we're in 2024, maybe 25. What is the real driver of these assessments? Is it level playing field, or is it global stability? And I'm not sure. The first Basel Capital Accord, 1988, but there weren't any assessments until 2012, after the GFC. And that might suggest that these jurisdictional assessments are more focused on the issues of prudential spillovers than on the level playing field dimension. After all, as far as I can make out, the assessors are public sector people, not employees of the big banks, who are arguably the entities most concerned with ensuring a level playing field. So I'm still not sure whether we should think of the assessments as primarily stability oriented or level playing field oriented. Now, I have some more notes of things I'd like to say, but I've had my 5 minutes. I'm sure I'll come back to the other points that I have in mind. So I'll leave it over to you, Nicolas.
Thanks, and thanks to both of you for being so mindful of my own obsessions with time discipline. Stefan, do you want to answer to Patrick's question? Is it level playing field? Is it global stability? What is it?
I would argue that you actually have elements of both. And Patrick are absolutely right when he says that these are two elements. And originally, the whole Basel Committee process started out with relatively few countries actually at the table. And it's a fact of the matter that what the Basel Committee is actually working and discussing is with reference to internationally active banks. That's the sort of the origin of the whole thing. The issue, though, is that there is no clear definition of an internationally active bank. And at the same time, and I think that this is more of a sort of a practical reflection, many of these, many of the elements of, for the sake of what is nowadays called Basel III, is highly, highly technical. And you have nowadays, I think the IMF and World Bank, the IMF has around 190 members. And that means that for a good number of them, they are just not in a position to produce these technical things themselves. So even if you limit this to a limited number of countries participating in the process, many, many others will look at what you have done and take that as a guidance or a measuring rod when it comes to what you are expected to do at home. And that also has something to do with the way the world has evolved, because today, if you have a domestic banking sector and you look outside your own country, and you either already have or are striving towards a completely open economy with free capital flows, then it makes a lot of sense to you to actually use the same or roughly the same set of rules that everybody else is using, because it actually puts you in a better position when it comes to explaining to others what you are doing and what you are trying to achieve. At the same time, Patrick is absolutely right when he says that there is a difference between thinking about level playing field and prudential rules. And let me add to that, then, which is kind of dealt with partly outside the Basel Committee itself. This is also part of a political process. So clearly, above all of this, you also have the political economy of bank rules, which make this kind of rather complicated. And that means that you can't argue that this in some sense always is intellectually totally pure. As when it comes to all international cooperation, you just have to make compromises in order to get things done.
So we have a question from Jerry Caprio, who is looking at it from a practitioner. He reminds us that he was co-chair of the Bank Fund Liaison Committee that oversaw the FSAP, the Financial Sector Assessment Program, in the late 90s and early 2000s. And he said, we have so many standards, does that mean anything? And he mentioned that Ireland and Iceland both had relatively favorable assessments. I quote from his question just before their crisis. I guess that's a question to both of you, Stefan as a former IMF person, Patrick as a former Irish person, among others, and also World Bank. What do you make of that critique? Is it the case that the FSAP process failed with Iceland, Ireland, and maybe other crisis countries, or would you view it in a more nuanced way?
I would, if you allow me to start, I would argue that it's much more nuanced than that. And that is also because the political economy of capital rules, just to use that as an example, is such that things tend to over time get diluted or not implemented. And then in our types of economies, there is a kind of a political agreement that it's okay to run banks with a leverage ratio, let's say around 5%. And if you do that, then you will end up with problems in the financial sector from time to time. Some of those problems were, of course, not generated from the beginning in the financial sector as such, because you can have a fiscal problem, and you can have a problem with sovereign debt, and you can have all sorts of other problems. And we human beings are simply not all that good at staying on the straight and narrow road. And I think the Reinhard Rogoff book, This Time Is Different, speaks to that. But still, we have to try.
Yeah, I definitely agree with that. I think it is important, there are important distinctions between the sort of approach that the Basel core principles, the FSAP, have had and continue to have. In a way, they are broader than these Basel process jurisdictional assessments, because they look at the way supervision is operated, and they look at the business, to some extent, at the business models of the banking system. That is out of scope for these Basel Committee assessments. So the Basel Committee assessments are much more detailed in regard to the rules and regulations, but they're not covering these institutional aspects to a great extent. Now, Jerry's absolutely right that I can say definitely in the case of Ireland, the FSAP process failed rather badly, and it gave Ireland good marks a very short while before the collapse. And that was partly because of the difficulty of accurately measuring capital, a difficulty which has been partly helped by new rules in the Basel process, but we saw it problematic again in the SVB collapse of 2023. So measuring capital is always, capital is great if only you could measure it properly. I did say in some report that the FSAP for Ireland was not very helpful. When the FSAP team came along during my jurisdiction there, they said, we hope to be more helpful this time, which I took as meaning that they were going to be a lot tougher. But I think that the other problem with this whole process is box checking. Now, there have been some updates of these Basel assessments, but basically it's sort of one-off so far. But we'll see what happens when it comes to assessing the Basel endgame. But the Basel core principles and the FSAPs, they tend to ask the same questions. And the first time you mightn't get the questions all right, but the second time you're a slow learner if you don't know how to answer the questions to give you a passing grade on those. So I'm a little bit distrustful of these large manuals that explain to everybody how to assess things, because that it moves away from the sort of qualitative judgment calls that are needed if you really got to see whether the supervisors have their the problem under control.
Let me add to that though that I think it's important to be mindful of the fact that regardless of whatever Roman number you use for Basel or all these other standards, at least it's a way of trying to measure what the participants in a certain group are doing. And that's a step forward compared to not trying to measure these things at all. Because in the old days, countries kind of jurisdictions said, yes, we're going to do Basel I. And whether you actually did Basel I or II fully or not, you could never really understand, not even at the committee table. And that's a step forward, but that doesn't mean that these things are perfect, and it doesn't mean either that they cannot or should not evolve over time, because there certainly are elements of learning by doing in all of this. And keep in mind that in my short introduction, when I started talking about the Riksbank Stability Report in 1977, and when I mentioned the FSAPs, the Financial Sector Assessment Program of the IMF and the World Bank, and then various other standards assessments that have been introduced over time. In all those cases, we basically started with a blank sheet of paper. And no one had told us how this should be done, nor was there a collective knowledge out there available how to do this. So it's only when you have done 50 or 100 and a large number of these that you eventually sort of learn what comes out of it and how you eventually maybe can improve on things. And let me add to that also in order to actually do the work, various jurisdictions need to accept that you show up and that you are sort of poking around and that you ask them to open their books. And to quite a number of jurisdictions, that's not easy to do in the early days, because you just haven't been subject to that before. And that makes you feel uncomfortable having these other guys actually running around asking you all sorts of strange questions. My point is just that there are important elements of learning by doing in all of this.
I think one thing I'd like to say, which is completely consistent with that, is that the sophistication of these assessments is quite impressive. And you said, Stefan, that this is beyond the scope of the IMF to be going into so much detail as is attempted and indeed done in these Basel framework assessments. I had a look, so there are 28 jurisdictions involved, because it's only 19 separate jurisdictions, because the European Union collects several of the other members. 5 different dimensions so far of the Basel framework have been separately assessed. And okay, there's a little bit of double jobbing. I counted up, there have been 120 different assessments over the years. And that's not junior people. The assessment teams have I saw some that just had as few as 5 on it, but then there were other ones that had 9 or 10 members of the assessment team. And the chair of the assessment team, senior people, deputy governors of top central banks, and that was plus local support, plus BIS support, and another review by multi-member teams. So this is a big effort. Has it had an impact? And I think we can see it certainly has had a definite impact, at least in some jurisdictions. If you look at, for example, Argentina, they did a review in 2016 on the capital adequacy. And the interesting thing I found looking at that one was that there was a self-assessment by the Argentines, and then a preliminary discussion with the Basel reviewers. And then the Argentines said, oh yeah, you're right, we need to change this and this and this. And they changed a lot of things. a cutoff point was established. The Basel assessors said, July the 6th, 2016, that's the date we're going to use. If you want to change something, you've got to have changed it by July the 6th. And so on July the 1st, the legislation was appropriately changed. So they actually did change that. It's not just Argentina. The same can be found in Indonesia, and the same can be found in China. So the same cannot be found in the European Union, as far as I can make out.
We'll come back.
So maybe it only applies to some countries.
I will come back to the European Union. We actually have questions from both Martin Helveg on Switzerland and from Stan Maas on the EU or the Basel process, but seen from the EU, from the perspective of the EU experience. But before we get to that, Stefan, I would like to ask you about what Patrick was alluding to, which is the difficulty of measuring capital. Do you think we have made progress, or the intrinsic difficulty of getting capital measurement right remains unchanged? What's your perspective on that?
I do think we have made progress, but it is actually very, very difficult when it comes to doing these things. And speaking for myself, and I usually upset many, many bankers in the private sector, we have all these endless arguments about risk weights, but risk weights, that's sort of like producing a weather report. The leverage ratio tells you about the size of your rubber boots, and that is what really matters at the end of the day. But I truly agree with Patrick that these things are hard to do. And that's also because accounting rules are also part of this. And accounting rules are difficult to deal with in their own right. And accounting rules, again, brings us into a whole maze of almost philosophical issues, where at the one extreme, you have people like myself who are sort of used to looking at marking everything to market because it tells you something about what's going on. And then you have the other extreme of the spectrum where others would want to say, I don't want to mark anything to market because my institution is going to last for a long, long time. And that means that we should use a different methodology. So these things are genuinely hard to deal with. And that is also because it's very difficult to deal with black swans. And that's why you end up with these episodes where all the numbers were beautiful until the next morning they were not. And that's why it's so hard to deal with these things. It's sort of a kind of, I don't know, maybe I shouldn't call it second best, but an alternative, which is not really dealing with Basel III compliance, is various forms of scenario analysis and stress testing. Because those methodologies grapple with the same issues. How do I measure, and how comfortable am I that this particular financial institution can take a hit without serious problems and particularly without serious problems for the system as a whole. And particularly the latter issue is a really difficult one to deal with, which actually goes way beyond the work that the Basel Committee does. And that is that it's one thing to deal with individual institutions. It's a completely different thing to deal with the system as a whole. And then you have this half world in between, where basically the issue is, does it take 1, 2, 3, or 4 or 5 institutions in trouble before the whole system ends up in trouble? And we just haven't come up with the answer to that as of yet.
This is very much the Silicon Valley Bank story, the way I understand it, right? How can you ring fence the problem institutions, or maybe you cannot, and you have to go for bailout, or in that case, systemic risk exemption. We have an observation in the Q&A tool from Udaybir Das, and since Udaybir has been very instrumental in many of the stories you've been talking about, Stefan, I just want to read it. He says, the targeted focus of the Basel RCAP process, not the IMF FSAP process, was the notion of materiality. So I guess this is a response to the point on box ticking. And why did it matter for the integrity of prudential policies in jurisdictions? The spirit was that the RCAP will evolve into a rigorous materiality exercise and not just a form of compliance undertaking. Udaybir says he thinks that integrating the RCAP with the other evaluation exercises, whether it's the FSAP or self-assessments would have been desirable. So I see a note of regret here. This is me, Nicolas talking. Udaiber continues, as I understand, the Basel Committee has been incorporating the RCAP findings into its ongoing work. So reforms coming out of the RCAP to clean up the quality of prudential quality across jurisdiction, including the USA, has been impressive. Any comments on that, Stefan? You have worked a lot with Udaiber.
Yeah, no, I mean, first of all, Udaiber was absolutely instrumental when it comes to doing the kind of the legwork, getting the process going. And I think that Udaiber uses the word materiality, which is important, because keep in mind that you agree to do something around the table, usually in Basel, and you write up quite complicated documents telling you what it means to do certain things that you have agreed to do. And then countries have different legal frameworks. Countries make legal changes and other changes at different speeds, and sometimes you need to change the law, sometimes it's secondary legislation, and so on and so forth. And that means that from a very sort of narrow angle in terms of the agreement that you have reached, it makes sense actually to assess materiality, basically saying that countries are different. Is a particular jurisdiction in some sense close enough to the agreement or not? And then you try to answer that question. But Udaiber is also correct when he says that that's a quite narrow process compared to the much broader process, which is basically the work of the IMF, the Financial Stability Board, and maybe others who ask themselves, what does the system as a whole look like for the world or in a certain jurisdiction? And to what extent does this system seem to be safe or not, given what they have done? But from a diplomatic perspective, the term materiality is very important in this narrow context.
Any comment on this?
Well, the thought that crosses my mind, apart from the fact that Udaiber and myself did an FSAP with Tanzania, and everything has been fine since then. So,
causation.
Absolutely. But it occurred to me that it's all very well to decide whether there are material differences, but then what happens? Are there consequences? And if I look at the overview that Basel Committee sets out of these assessments, it's not exactly the same overview that Stefan was talking about, but it's a sort of a standing back overview. There's only one red mark, and that's against the European Union. And that red mark was established, 10 years ago or something like that. And it doesn't seem to have changed, or if it has changed, the process hasn't caught up with it. So what are the consequences of getting a red mark? I also noticed that the only country of the 19 jurisdictions to have got a fully green mark in this particular table are China. So I'd like to think that maybe the Basel Committee is a last bastion of global integration if China is on board with the international community, even more than any other jurisdiction.
We will come back to the EU because we have a question from Stan Mas, and even so it's about the process in general. I think it can be read in an EU context. But before we get to that, and also Martin has a question about Switzerland. Stefan, do you want to make a brief comment about China? Is it shocking that China is fully compliant?
No, first of all, to Patrick's comment, I mean, given that you can't, there is a limit to the resources that you put into this process. It takes years and years and years to actually go through the whole thing. And that, of course, by necessity means that some of these assessments eventually become old and maybe also stale because things have moved on. But this is just what you have to live with when it comes to international cooperation. And the fact of the matter is that everything is based on soft law in the sense that these are agreements that countries have agreed to accept in some sense. And if you don't want to comply, then you don't want to comply. But it's better to have a record of non-compliance compared to not having having it at all. But I also think it's fair to say that the technical part of this actually comes out of the work done by technicians. But then eventually in almost all jurisdictions, you add an element of the political economy of these things. And that, of course, sometimes actually changes things in the sense that you have an agreement to implement something, let's say, within a certain time frame, and then it just doesn't happen because the politics of it is such that there is no political support for implementing what has been agreed. And then, of course, ultimately at the end of the day, given the type of international cooperation we're talking about here, it's actually up to jurisdictions themselves at the political level to decide whether they want to be in compliance or not in compliance. And you eventually will have to decide whether it's good or not so good for your banking sector as such. And that's a set of issues in its own right. And then another aspect of it is the diplomatic aspect of it, whether you want to be a good, nice global player or not.
Is that an answer to my question about China, or do you want to say one more word about that particular case?
I really haven't focused on China lately, but I do think that Patrick made a good point earlier when he mentioned Argentina, because quite a number of countries actually have over the years made an effort to make sure that they adjust their domestic legal frameworks in such a way that they actually are in compliance. That doesn't mean that you can't end up with problems anyway, because the Basel III doesn't insulate you from, let's say, all sorts of issues in the
That's right.
In the property market. That's for sure. So you can still be in compliance with everything and have serious problems in your own economy.
That's an important point to make. So Martin Helvig, let's come to his question. He asked about compliance and non-compliance in the context of Credit Suisse. And I read, in the case of Credit Suisse, it turns out that the standards set by the Basel Committee for Pillar 2 were not met by Swiss law. That's his judgment, not mine. Swiss law allowed Pillar 2 interventions only after the supervisor had declared a point of non-viability to be closed. How do you see this discrepancy? I guess that's primarily a question to you, Stefan.
Actually, it would be a better question to the people in the secretariat, since I'm not dealing with this on a daily basis. But at the same time, I do think that it's a good example where you find these differences. And in some cases, in some jurisdictions, you're in compliance with everything. And in other jurisdictions, you sort of are in compliance with bits and pieces. And then particularly, and this is a difficult issue, because let me back a little bit, because part of it is really Basel Committee work. Another element of it is what is called Pillar 2, and Pillar 2 is basically where jurisdictions and supervisors can, in a vague sense, decide on their own. And that means that Pillar 2 is not technically highly regulated, and it's very difficult to deal with when you look at it across jurisdictions, because there are many degrees of freedom, and some jurisdictions use a lot of Pillar 2 stuff, and others don't. And this is kind of then what you end up with. But here, in addition to this, part of this actually comes from the work that was done together with the Financial Stability Board on what is called GSIBs, globally systemically important financial institutions. And that's where together with the Basel Committee, where the whole framework dealing with bail-in was evolved over time. And we just simply do not have a lot of practical experience when it comes to using those set of rules, because these events fortunately don't happen with all that high a frequency. And we don't even know if these rules are de facto really workable over time, which is a set of issues in its own right. And it's hard, since I've had to do these things myself in the middle of the night, to check all the various paragraphs when it comes to how you do these things. And sometimes you actually run out of time, and you have to do what you have to do at 2 o'clock in the morning.
if I could add a point, I mean, I'm not particularly addressing Martin's specific point because I wouldn't claim to be an expert on it, but it seems to me that one of the problems that we have got now, because we've become so rules-based and detailed rules, that the rules are so detailed and complex that market participants move towards regarding the rules as the game that has to be played and forgetting really about risk management principles. They assume the rules will keep them safe on the risk management side. And I think we saw that in the Credit Suisse, not on that particular point, but on the point of the LCR, the liquid ratio, where it turned out that it was compliant with the rules that the Swiss National Bank or the supervisor had set out, but they couldn't get their hands on the liquidity, even though it was supposed to be compliant with the liquid assets. And that's because the way the rule was defined allowed a sort of maneuver. So I think that is a real problem with this accumulation of rules. And indeed, if nothing would convince you more about the complexity of these rules than to look at the Basel framework and the amount of detail that's in it. Maybe that is the only way to go, but it is a way that has costs.
So let's get to the EU and to Stan's question. Stan Maas from the unit in charge of bank regulation at the European Commission, but of course speaking in a personal capacity, says that his opinion is that the existing RCAP regulatory consistency assessment program methodology has two significant weaknesses. The first weakness, is that the RCAP methodology and the corresponding scoring are focused on assessing deviations to Pillar 1 requirements, as these type of deviation can be measured relatively easily, but put little emphasis on the assessment of the Pillar 2 framework and supervision. So that's kind of the same point as Martin Helvig raised. The second point of Stan Maas' question is RCAP methodology also neglects important super equivalent requirements that certain jurisdictions have put in place, such is the case in the EU, the broad scope of application of the standards. All banks in the EU implement a full set of standards, not just 9 banking groups, as in the case in the US. The level of application of the standards at consolidated and legal entity level in the EU, not just at the consolidated level. So active use of macroprudential requirements and the level of transparency that jurisdictions are providing. So the 2023 banking turmoil illustrated that a broad scope of application is supporting global financial stability. So Stefan, is the Basel Committee getting it right? Are these well-known EU counter-arguments? Let's remind that the EU was considered materially non-compliant in the assessments of 10 years ago. Do these arguments have traction? Can you get us a little bit of a sense of how?
No, they do not. They do not, because you are free to be super equivalent if you want to, which is probably good for the system as a whole, but it doesn't help you when it comes to the assessment as such. It's not harder than that.
And so basically what you're saying is that it finds that the EU is imposing Basel to all banks, no matter how small. It finds that the EU is imposing requirements on top of Basel, but if it doesn't comply with the Basel requirements, these additional things don't offset the non-compliance, right?
That is correct, because it's extremely difficult when you do these assessments to judge what you would call super equivalence and other things, for example, Pillar 2. Then, at least during my time, and I can't answer to how the Basel Committee is discussing these things presently, it was hard enough to focus on Pillar 1, and as all of you know, or many of you know, those of you who are watching here today, it took many years to deal with that, and at the same time, during my time, there wasn't much of an appetite to deal with the Pillar 2. And that was kind of left to countries to deal with among themselves. So my view is kind of that you have to accept that these assessments are sort of rather narrow, and if it bothers you that that's the way things are, you have to argue your case at the Basel Committee table. And if you still are convinced that your financial sector is beautiful, it's your job to sell that story.
So let me just, of course, it's like sake of argument. Yeah, go ahead, Patrick.
Yeah, I just want to add one point on this super equivalence. it's all very well to say we're super equivalent on so many areas and that we've got a very safe system. And so don't be bothering us with this little detail in one part of banks' activities that we are not controlling. But that doesn't satisfy the level playing field criterion, because that loophole, it may leave your system safe because you've got so much super equivalence, but that's a loophole that will allow your banks maybe to undercut the banks from every other country in the world in that sector, so destroying the level playing field and therefore destroying the foundations of the agreement that gives you the Basel Accord.
No, this is, let me add to that. This is a highly relevant point, and we started out almost an hour ago talking about that, because you have the supervisory and financial stability aspect of this, but the other one is actually the level playing field aspect of it, and the level playing field aspect of it always gets embroiled with various types of political arguments on top of that. And that's why one could argue that I don't know what number to put on it, but it's not a first best world that we live in. Maybe it's a number far down the list.
So one aspect of Stan's rationale, which I have a certain degree of sympathy with, is about the scope of application, because the Basel Committee says large internationally active bank. Well, Silicon Valley Bank was large, and technically it was internationally active through its subsidiary in the UK. Nevertheless, it was not within the scope of application. Shouldn't that be viewed as a breach of Basel?
I'm not here today to pass judgment on these sort of technical assessments. I would leave that to the assessment teams dealing with this stuff, because they are in a much better position than I am to actually pass judgment on these things. But I do think that in an imperfect world, you just have to live with some of these imperfections and try to get better over time. And the starting point was internationally active banks a long time ago, but unfortunately, the committee was never able to in detail define what an internationally active bank happens to be, and that remains to be done. Probably in addition, with more work on looking into Pillar 2.
So I have a question to you, Patrick, before we close. As somebody who comes from a country which is not a member of the Basel Committee, except, of course, through Ireland's membership in the European Union, there are lots of European Union countries at the Basel Committee table, as Stefan referred to it, and indeed lots of Eurozone countries. There are 7 in my count, including in no particular order: Germany, France, Italy, Spain, the Netherlands, Belgium, and Luxembourg. So is that too many? Does it make any sense now that we have European banking supervision, now that European supervisory policy, I'm leaving Sweden off the hook, Stefan, but now that we have supervisory policy set by a framework where all these Eurozone countries are under the same umbrella, isn't it time for the Basel Committee to revisit its membership, or more accurately, for some of these members to just gracefully exit because their solo membership is no longer appropriate? How do you view that interesting question from an outsider perspective?
Well, I think this question arises in a number of other international institutions, including the IMF.
It's kind of a caricature of this, because it's a committee on banking supervision, and indeed we have a single banking supervisory policy in the Eurozone.
No, there's a great deal of logic in what you're saying. I suppose it would have been a peculiar situation to have the United Kingdom not represented on the Basel Committee until 2016, and suddenly having to rush back. Although, in fact, it's not the European Union; it's only the banking union ones that you want to throw out, isn't that?
My
yes.
point about
you don't want to throw Sweden out. It's all right.
That's why Sweden is off the hook. Yeah. Very diplomatic. We're at the hour, unfortunately, because we could continue forever. We haven't even talked about the Danish compromise, and I'm the culprit for that. So thanks so much. This was, there is so much wisdom and experience and insight among the two of you that I can only be humbled and very grateful. We'll have the next session of this series on the same day as Patrick will be presenting his book at the Peterson Institute, but a few hours earlier on December 11. We will have a bit, for once, of a French focus, and I apologize for that, but we will look at BPI France as a case study of government intervention into the high-growth startup venture capital market. It's a very interesting case study with Arnaud Codou, who is the deputy head of BPI France, and a second speaker who will be announced in the meantime. In the meantime, many, many thanks for this wealth of insight and wisdom, as I said, and thanks very much for having participated today.
Thank you. Bye now.